Right now, fear is driving a massive rotation out of quality growth stocks, and the data says investors may be making a big mistake. So in this video, I'm breaking down 3 monopoly-style stocks that could represent strong opportunities right now. These are the kind of businesses that dominate their niche, have pricing power, and don't necessarily need perfect market conditions to succeed. I'll show you what makes each one a monopoly or close to monopoly and what you need to know as you research each stock. Now, most importantly, be sure to stick around to the end because the last one looks like a pretty good value right now, and you don't want to miss out while it's so attractively priced. By the way, I'm Steve Reitmeister. I was the editor-in-chief of Sachs.com for many, many years, where I delivered insights to million investors, and now I'm a partner at WallStreetZen.com, where our Zen Ratings systems helps investors like you identify high-quality stocks without all the noise and nonsense. So please give this video a like if you're into topics like this, then I will know to record more like this in the future. Okay. One last thing before I start, this video should not be considered investment advice or a recommendation to buy. Always do your own due diligence. Okay, now let's get on with what's happening in the market. Money isn't leaving, it's rotating. This is what most people are getting completely wrong right now. Investors are dumping quality growth stocks and piling into slow growth safe names. That party won't last forever. I mean, you've got Walmart trading at roughly double the forward PE of companies with better growth, stronger economic moats, and higher returns on capital. That's not normal, that's fear-based, and that often proves to be temporary. And that fear is being driven by two different narratives. AI will destroy every software company, right? Hearing that one a little too much these days. And then the second being big tech capex is out of control and will come down in time. Now, both of these have a kernel of truth, but here's the problem. They're being applied indiscriminately. Good companies with improving fundamentals are getting sold off right alongside the weak ones. And when hedge fund managers are reading the same panic pieces as retail investors, that moves prices. And when prices move without fundamentals breaking, well, that's where potential opportunity shows up for the rest of us to take action. Let's get on to those 3 stocks, starting with number 1 in Bristol-Myers Squibb with a symbol of BMY. This may look like a boring pharma dividend stock, yet it's actually a consistent growing company that is beating the S&P 500 while so many of the tech stocks bleed, right? As I record, BMY is up nearly 40% from last year's low, yet almost no one is talking about them as a good investment opportunity. In case you're hazy on it, Bristol-Myers Squibb is one of the world's largest pharma companies, spanning major therapeutic areas from cancer to cardiovascular disease. Its strength is concentrated in 3 high-impact categories: cancer immunotherapy, blood clot prevention, including Eliquis, a big name drug co-developed with Pfizer, and blood cancer treatment. These aren't just leading edge drugs. They're embedded in the system as the standard of care. Hospital systems, insurers, and clinical protocols are built around them, creating high switching costs. Combined dominance in oncology and cardiology gives the company a moat that's very difficult to replicate. But yes, the patent cliff is real. 2 of its biggest name drugs lose exclusivity around 2028. But the growth portfolio, which excludes those drugs, now accounts for 55% of total revenue, up from 47% last year, most signs pointing towards that being a larger and larger share leading up to that 2028 cliff. They are coming off an impressive earnings beat, and yet shares are still trading for a rather low forward PE of just 9. Not to mention you get a hefty 4.3 dividend yield with this stock. Now, top Wall Street analysts are pounding the table on BMY. That includes Seamus Fernandez from Guggenheim with a strong buy rating. Remember, stock analysts aren't perfect, but I think he is worth listening to as he's in the top 2% of analysts based on his actual stock picking performance. Likewise, David Amsellem from Piper Sandler is also on board with a strong buy rating, and he's in the top 6% of analysts given his impressive historical track record. Now, Bristol-Myers is also the top company in the general drug manufacturing industry according to the Zen Ratings quant model. Not only do they have an elite A rating overall, but they actually rank in the top 2% of all 4,600 stocks we track in our model. That points to a special fundamental profile that has historically resulted in a higher likelihood of more share price gains ahead. Now, let's drill down to the component grades of our Zen Ratings, where value is a key strength, earning an A rating. Despite its strong market position and solid dividend and healthy cash flow, the stock still appears woefully undervalued. I think this makes it a very attractive relative to what the company delivers in the growth category. Now, safety is another A grade, where the company scores in the top 3% of all stocks in our system. Now, BMY boasts a strong balance sheet, and a significant portion of its earnings are protected by patents. And hey, being a pharma company, generally going to be a lower volatility stock. That's why it scores so well in safety. Financials and momentum both earn B ratings, which puts them in the top 20% of these key categories. Overall, it looks like a highly reliable stock with a potentially favorable entry point. As previously noted, prominent patents are expiring in 2028, which is the primary concern in the market right now. This fear-driven narrative has priced the stock lower than it deserves to be. However, when you combine the stellar Zen Ratings insights along with support from top Wall Street analysts, then there is ample reason to consider the stock, especially if they're going to hand out a hefty 4.3% dividend yield on top of that. All right, quick pause. Before we move on to the next Monopoly stock, I'd kindly ask you to subscribe and hit the notification bell. That's because I record videos like this frequently, and subscribing is the best way to ensure you don't miss any of my coverage in the future. Now, let's continue on with those stocks. Monopoly stock number 2 is Nvidia with the symbol NVDA. Now let's move to the one that everyone's talking about, and you already understand. Nvidia dominates the data center GPU market for AI workloads. Everyone knows that. They control over 90% of the market, but that's not the real story here. The real story is why that dominance is so hard to break. It's not the hardware, it's CUDA. What the heck is that? Okay, CUDA is a 20-year-old software ecosystem, and every AI model, every training run, every inference pipeline runs on it. Okay, developers have spent 2 decades building on CUDA. You don't replace that with a better chip. That's not competition. That's structural lock-in, and Nvidia is doubling down on that with things like NVLink Fusion. They've actually opening the ecosystem to integrate third-party chips. I know it sounds counterintuitive, but what it really does is turn Nvidia into the operating system of AI infrastructure. They're becoming even more entrenched, not less. Okay, now let's talk about the numbers. Data center revenue is running at roughly $39 billion per quarter. And new chips like Blackwell Ultra are already shipping, and Vera Rubin is coming later this year. The roadmap is intact. The growth is still there, but the stock has experienced recent volatility along with many other AI and big tech names. But there's plenty of reason to be optimistic, starting with analyst coverage. Out of the 32 analysts covering Nvidia, 24 recommended as a strong buy and 7 recommended as a buy. That is extremely bullish coverage from the Wall Street community. Even after a 12-fold increase in the stock price over the last 5 years, analysts still see more upside. Right now, among the analysts we track, the average price target implies nearly 60% potential upside in the year ahead. Meanwhile, the street high targets point to more than 100% potential gain. Now, analyst ratings are educated opinions, not fortune-telling, but that's a big vote of confidence from people who know the market quite well. Our Zen Ratings quant model agrees that Nvidia is still the one to beat. It ranks in the top 5% of companies in our universe, earning an overall A or strong buy rating. Now, financial strength is a true standout here in the top 1% of all stocks we track. This is no surprise to anyone. This is a cash-generating powerhouse with consistently top-tier operational metrics. The company also earns a B rating from our proprietary AI factor model that points to the most timely stocks. Sentiment is a B as well, with the smart money still clamoring to buy these shares. Now, on the risk side, safety scores a lowly D rating. That puts in the bottom 20% of all stocks. This is because of excess volatility and huge price swings. Not to mention the stock is priced for perfection, leaving little room for error. Competition exists at the edges from the likes of Broadcom, Amazon, AMD, and Google. They aren't threatening Nvidia's core business, but they are chipping away around the margins. However, the core monopoly, that CUDA, remains intact, and that's what truly matters for investors at this time. Now, before that last peg, a quick reminder. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. Now, get my stocks of the week for free. Just click the link in the description below or scan the QR code. Our third and final stock is Gilead Sciences with a symbol of GILD. This is the closest thing to a true monopoly in this entire video today. Now, as you likely know, this is a biopharmaceutical giant, right? That they have deep specialization across hematology, oncology, cell therapy, liver disease, and HIV/AIDS. But it's the HIV/AIDS segment where their dominance becomes almost hard to believe. Gilead doesn't just treat HIV. It owns the entire care continuum, from prevention to long-term treatment, and their newest product launch extends that reach even further. Altogether, they've locked in a market position that competitors have spent years trying to crack, and yet still they have a dominating 55% market share. And here's a big one most people are missing. They reached a most favored nation pricing deal with the U.S. government. That gives them a predictable 5-year pricing roadmap. That's a big deal in a sector where regulatory uncertainty previously crushed multiples. On the Wall Street analyst side, sentiment is overwhelmingly positive. Nearly 85% of the analysts we track give Gilead a strong buy or buy recommendation. Now, our Zen Ratings model also appreciates the fundamental prowess of Gilead, leading to an A rating. That's because they are in the top 3% of stocks we track. Historically, stocks that rank so highly had a greater likelihood of future outperformance. Gilead also scores well for the value component grade, ranking the top 2% of all stocks. Now, our system sees it as a bargain, especially when you think about the monopoly strengths highlighted earlier. Financial strength is another A grade, reflecting the company's strong cash flow generation and history of consistently impressive returns. A return on equity of 41%, return on assets of 14.8% are both well above the industry average. Safety and momentum are solid as well. In these key areas, they get B ratings, which notes the top 20% showing of all stocks. Now, as to the risks, I do have to note their oncology drugs haven't fully delivered on their potential yet, and Medicare pricing pressure is always a factor to consider. But here's the bottom line. If the new drugs in the oncology pipeline hit, on top of their HIV dominance, then this becomes a special growth story that propels shares much, much higher in the future. So let's take a step back. 3 stocks, 3 completely different sectors, but one common thread. They all appear underpriced relative to the impressive growth and quality of their near monopoly businesses. Here's the pattern I've seen over the decades. When high-quality companies that have improving fundamentals get sold off, it's because of fear. And right now, the data is telling you that these 3 stocks may be on the wrong side of that fear. That could create an opportunity for savvy investors. So here's the question. Which of these 3 stocks are you most interested in and why? Please share your thoughts in the comment section below, as I love having these discussions with other investors. Finally, if you like this video, then be sure to check out my next video featuring 3 potential stocks to buy on the dip and 1 to avoid.